Welcome back to the Algobot channel, where we take apart automated trading strategies and study how they actually think. I'm Algobot, and today we're examining an expert advisor for MetaTrader 5 called Calm Range Spike Reversion. This is a mean reversion approach built around a moving average anchor and two average true range measurements. It only looks for a trade when the market is quiet and balanced, and then it fades a single sharp spike that snaps straight back inside a volatility band. By the end of this video, you'll understand its regime filter, its entry rules, its stops and targets, and the reasoning behind each one. Let's get into it. Let's start with the big picture. Calm Range Spike Reversion is a mean reversion expert advisor. Instead of chasing momentum, it waits for price to stretch away from a fair value line and then bets on it returning. The fair value line here is an exponential moving average, by default over 50 bars, and the strategy treats that average as the anchor or the mean that price tends to gravitate back toward. Around that anchor, the strategy draws two volatility bands using a short window average true range, by default 14 bars, multiplied by a band factor of 2. So the upper and lower bands sit roughly 2 units of recent range above and below the moving average. A second, longer average true range, by default 50 bars, is used purely to measure whether volatility is expanding or contracting. Now here's the part that defines this whole approach. It refuses to trade most of the time. Before it even looks at a spike, it checks that the market is in what it calls a calm regime. Two things must both be true. First, the trend must be flat, meaning the moving average has barely drifted over the recent look-back window. Second, volatility must be contracting, meaning the short average true range is sitting below the long one. Only when the market is quiet and going sideways does the strategy consider a trade at all. The idea is that in a genuinely trending or expanding market, a spike can be the start of a real move, and fading it can hurt. But in a calm, contracting market, a lone bar that spikes out and immediately snaps back is far more likely to be a temporary liquidity flush than a new trend. This EA is designed to trade only that specific situation. In terms of who this is framed for, it's an educational example of a selective, patient, rules-based reversion system. It trades infrequently, holds one position at a time, and always defines a stop and a target in advance. Remember, everything here is for educational purposes only and is not financial advice. Trading carries real risk, and losses are a normal part of any strategy. Now let's walk through the exact logic, step by step. Everything is evaluated on completed bars, so the strategy only acts when a new bar opens and the previous one has closed. It also holds just one position at a time. First come the two regime gates, and both must pass. Gate 1 is the flat trend test. The strategy measures the exponential moving average now, and the same average a number of bars ago, set by the slope lookback of 20. If the difference between them is smaller than the flat factor, which defaults to 1, times the short average true range, the trend counts as flat. In plain terms, the mean has barely moved, so the market is going sideways. Gate 2 is the low volatility test. The short average true range must be below the contract factor, which defaults to 0.9 times the long average true range. When recent range is smaller than the longer-term range, volatility is contracting, and the market is calm. If either gate fails, the strategy does nothing and waits. Once both gates pass, it builds the anchor and the two bands. The anchor is the moving average. The upper band is the anchor plus the band multiplier times the short average true range, and the lower band is the anchor minus that same distance. Now the entry. For a long, the strategy looks at the signal bar, which is the most recently closed bar, and checks 4 things. First, its low must pierce below the lower band. Second, its close must come back above the lower band, so price snapped back inside. Third, it must show a lower wick rejection, meaning the close sits in the upper portion of the bar's range, controlled by the WickFraction of 0.5. And fourth, the bar before it must still have been inside the band, which confirms this is a fresh, single bar spike rather than an ongoing move. When all 4 align, the strategy signals a buy at market. The stop loss is placed below the spike low, with a small buffer of 0.3 times the short average true range. The take profit is the anchor itself, the moving average, because that's the mean price is expected to revert toward. There's also a quality check. The distance from entry up to the target must be at least the minimum reward of 0.6 times the short average true range. Otherwise, the trade is skipped. The short side is the exact mirror. The signal bar's high pierces the upper band. The close comes back inside. An upper wick rejection is present, and the prior bar was inside the band. The stop sits above the spike high, and the target is again the anchor. Same reward filter, same logic, just flipped. Let's read the meta-editor code on screen. At the top are the input parameters. Trend period sets the exponential moving average anchor at 50. The short and long average true range periods, 14 and 50, drive the bands and the volatility check. Slope lookback of 20 defines how far back the flat trend test looks. BandMultiplier of 2 sets the bandwidth. FlatFactor and ContractFactor control the two regime gates. WickFraction controls the rejection tail, and stop buffer and minimum reward shape the stop and target. Now the long block. Spike down is true when the signal bar's low is below the lower band, but its close is back above it. Lower reject confirms the close sits high in the bar's range, and fresh down confirms the previous bar's low was still inside the band. When all three are true, the stop loss is set below the spike low minus the buffer, and the take profit is the anchor. If the reward distance is large enough and the stop sits below entry, the code calls trade.buy. The short block is the mirror. Spike up needs the high above the upper band with the close back below it. Upper reject confirms the rejection tail, and fresh up confirms the prior bar was inside. The stop goes above the spike high, the target is again the anchor, and trade.sell is called. Same structure, flip direction. Let's walk through this chart candle by candle and see the strategy in action. Notice the three dashed lines. The gold line in the middle is the reversion anchor, the exponential moving average, sitting flat at 1.0850. Above it, the blue upper band rests at 1.0870, and below it, the blue lower band rests at 1.0830. Because the market here is calm and going sideways, the anchor is flat and the bands are steady, which is exactly the regime this strategy waits for. Look at the first three candles. They're small, they overlap, and they stay comfortably between the two bands. The moving average has barely moved, and recent range is tight. Both regime gates are satisfied, so the strategy is now watching for a spike, but it hasn't acted yet. Now the fourth candle is where things get interesting. Price suddenly drops, and the candle's low pierces below the lower band at 1.0830. That's the flush. But watch what happens by the close. Price is rejected and pushes back up, closing well above the lower band, right up in the top portion of the bar's range. That long lower tail is the rejection the strategy is looking for. And crucially, the bar before it was still inside the band. So this is a fresh, single bar spike, not part of an ongoing slide. All four long conditions are met, and the buy entry marker appears. The stop loss sits just below the spike low, and the take profit target is the anchor, the gold line. Over the next couple of candles, price does exactly what the strategy expected. It drifts back up toward the mean. By the sixth candle, price has climbed back to the anchor line, and the take profit target is reached. The trade is complete, closed right at fair value. After that, the market settles again. Candles 7 and 8 are quiet and balanced, sitting between the bands, and the regime stays calm. The strategy resets and waits for the next opportunity. Then comes candle 9, the mirror image. Price pushes sharply higher, and the candle's high pierces above the upper band at 1.0870. But again, it can't hold. Price is rejected, and the bar closes back below the upper band, leaving a long upper tail. The bar before it was inside the band, so this too is a fresh single bar spike. All four short conditions align, and the sell entry marker appears. This time the stop loss sits just above the spike high, and the target is once again the anchor. From there, price eases back down toward the mean over the following candles. By the 11th candle, it reaches the anchor line, and the second take profit target is met. Both trades share the same simple idea. Price stretched too far, too fast, in a calm market, and returned to fair value. Notice how disciplined the reward setup is. The target must sit at least the minimum reward distance, 0.6 times the short average true range, away from entry, and the stop is anchored just beyond the spike extreme. That's how the strategy keeps its risk defined on every trade. Of course, Not every spike reverts cleanly, and some trades will reach the stop instead. That's a normal and expected part of any reversion approach. So that's Calm Range Spike Reversion. We covered how it defines a calm regime using a flat exponential moving average and contracting average true range, how it draws volatility bands around that anchor, and how it fades a single bar spike that pierces a band and snaps back inside with a rejection tail. We saw the mirrored long and short setups, the stop placed just beyond the spike, and the take profit set back at the mean. Remember, this video is educational information only and is not financial advice, a recommendation, or a solicitation. Trading carries real risk, and losses do happen. If you found this analysis helpful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment with the strategy you'd like us to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.